Okay, so you want to own a warehouse. Find a big building somewhere, let a company move their boxes in, collect a check every month. Sounds like the simplest business in the world. You're not making anything. You're not selling anything. You're just sitting there while the rent comes in. That's the idea, anyway. The reality is a completely different story. Because a warehouse isn't just a building, it's a financial instrument, one that can either quietly build you serious wealth over a decade or quietly drain every dollar you put into it without making a single noise about it until it's too late. So let's walk through what warehouse ownership actually looks like from the inside. The costs, the revenue, the hidden math, and the moments where perfectly smart people have watched the whole thing unravel. Let's start with what a warehouse actually is, not architecturally, but economically. When a business stores inventory or moves goods, every extra day those goods sit still costs them money. Every extra mile a truck has to drive costs them money. Every extra hour between a product leaving a factory and landing in a customer's hands costs them money. What a warehouse is selling at its most fundamental level is the elimination of that cost. It sells proximity. It sells time. It sells access to the right road, the right port, the right customer base. That's the economic engine underneath every single one of these buildings, and it's why two warehouses with identical square footage can have wildly different values depending on where they sit. Now, here's the first thing that surprises most people. When they actually try to get into this business, the price of entry isn't what you think it is. If you want to buy an existing warehouse in a decent location, not prime, not terrible, just functional, you're typically looking at somewhere between $1 million on the absolute low end for something small and aging in a secondary market, all the way up to $50 million or more for a modern large-scale facility in a major logistics corridor. The average industrial building sale in the United States over the last several years has landed somewhere in the range of $8 to $12 million for mid-sized properties in reasonable locations. But that purchase price is just the headline number. Before you own anything, the actual costs start stacking up immediately. You'll need a down payment. Commercial lenders for industrial real estate typically want between 25 and 40% of the purchase price in cash. So on a $10 million warehouse, that's $2.5 to $4 million in equity before you sign a single document. The bank covers the rest, but at a cost we'll come back to. Then comes due diligence. Before you buy any industrial building, you need to know what's been stored in it, what's soaked into the ground beneath it, and whether the structure itself is going to hold up. A Phase 1 environmental study, the standard first check for soil contamination, typically runs between $1,500 and $4,000. If that comes back alarming, you move to a Phase 2, which can cost anywhere from $5,000 to $50,000 depending on what they find. Building inspections, structural engineering, a land survey. By the time you're done just looking at the thing, you might have spent $50,000 to $100,000 before you own anything. Legal fees, closing costs, appraisal, lender fees. Add another $50,000 to $150,000 in transactional friction. These numbers don't move product. They don't generate a dollar of rent. They just happen before the game even starts. And then there's the building itself. Because many warehouses that are priced within reach of smaller investors are priced that way for a reason. Aging roof, old loading docks, outdated electrical. The moment you take ownership, you may be looking at an immediate capital expenditure, repairs or upgrades just to make the space usable enough to attract a tenant. That could mean another $100,000, or it could mean $1 million. There's no ceiling on what an aging industrial building can need, so the total cost of getting into the game, before you collect a single dollar in rent, is often significantly larger than the purchase price itself. But buying the building isn't even the most important financial decision you make. The most important decision is where the building sits. Here's the number that explains everything about warehouse location. Transportation costs, the fuel, the drivers, the trucks, the time, account for roughly 50 to 60% of a typical company's total logistics budget. The rent they pay on warehouse space accounts for somewhere between 5 and 10%. That ratio is everything. It means that a company will pay substantially more rent for a warehouse that cuts their transportation costs, because the savings on the transportation side can dwarf the extra rent they're paying. A warehouse sitting right next to a major interstate, 30 miles from a container port, within one-day delivery reach of 30 million people, that building can charge dramatically more than a warehouse with the same square footage sitting 60 miles away from anything important. Not because the building is better, because the location is worth more to the tenant than the rent premium costs them. This is why the same industrial building can trade at wildly different prices depending on where it sits. A modern warehouse in the Inland Empire in California which is the single largest warehouse market in the United States, serving the ports of Los Angeles and Long Beach, commands rental rates and property values that would seem almost absurd compared to an identical building in a secondary market 3 states away with no port access and no major highway nearby. Location is not a feature of a warehouse. Location is the product, and that leads to the obvious question. Who's actually buying that product? The tenant ecosystem for industrial real estate is broader than most people realize. E-commerce companies are the most obvious. Think of the enormous fulfillment centers that have reshaped industrial real estate over the last decade. But beyond that, you have third-party logistics providers, manufacturers, wholesale distributors, food companies needing refrigerated storage, importers breaking down shipping containers, construction supply companies. The list is long and diverse, and each category has completely different requirements for what they need in a building. An e-commerce company wants high ceilings, at least 32 to 36 feet of clearance, so they can stack automated shelving systems as high as possible. They want dozens of loading dock doors. They want a massive parking yard for trailer staging. A manufacturer might need extremely heavy electrical service for their equipment. A food distributor needs temperature-controlled zones and specialized insulation. A construction supplier just wants cheap square footage and a big yard to store materials outside. The point is that a building optimized for one type of tenant may not work at all for another. And the type of tenant you attract determines not just your rent, it determines the stability of your income and the long-term value of your asset. Now let's talk about the business model itself, because most people get this wrong in a specific and expensive way. The basic model sounds simple. Tenant pays rent. Rent minus expenses equals profit. That's the napkin version. The actual version involves several layers that change the math significantly. The number that every serious warehouse owner watches is not the rent. It's the net operating income, or NOI. That's the rent plus any other income the building generates, minus all the operating expenses. Before the mortgage gets paid, before taxes on your income. Just the raw operating performance of the property itself. Why does NOI matter so much? Because the value of a warehouse in the commercial real estate market isn't set by how much you paid for it. It's set by how much income it generates. Investors and institutions look at a building's NOI and divide it by what they expect an asset like this to yield. A percentage called the capitalization rate, or cap rate. A warehouse generating $800,000 a year in NOI in a strong industrial market, where investors are willing to accept a 5% yield, gets valued at $16 million. 800,000 divided by 0.05. That's the math the market uses. Here's why this matters in a very practical way. If you own a warehouse generating $800,000 in NOI, and you figure out how to push that to $900,000 through higher rents, lower costs, or additional income, you haven't just added $100,000 to your annual income. At a 5% cap rate, you've added $2 million to the value of the building. That's the lever that sophisticated warehouse investors are actually pulling. They're not just collecting rent. They're managing an income-producing asset whose value responds to every dollar of income they can add or subtract. Now let's destroy the illusion that rent equals profit, because this is where people get hurt, even in the most favorable lease structure, called a triple net lease, where the tenant pays property taxes, insurance, and maintenance. The owner still carries substantial costs that do not disappear. Property taxes on industrial buildings can be significant and are reassessed after a sale, often jumping meaningfully. A reassessment after you buy a building at a new price can create a tax bill that's substantially higher than what the previous owner paid. If your lease is already signed at a rate that didn't account for that jump, you absorb the difference. Insurance on a large industrial building is not cheap. Insuring a 200,000 square foot warehouse against fire, structural damage, and liability runs into significant annual premiums. Roofs. Roofs are the thing that keeps warehouse owners up at night. Replacing the roof on a large industrial building costs between $8 and $15 per square foot. On a 200,000 square foot warehouse, that's between $1.5 and $3 million. Not if it happens. When it happens. Roofs on industrial buildings have a finite lifespan, and when they go fast and they go expensive loading docks. The dock doors and levelers that trucks use dozens of times a day are high-wear mechanical systems. They break. They need maintenance. A warehouse with 20 dock doors needs to budget for ongoing repair costs that can surprise a first-time owner significantly. Parking lots and truck courts. Heavy trucks destroy asphalt. The concrete aprons around your loading docks, the truck yards, the parking surfaces, they degrade continuously under the weight of commercial vehicles and need to be maintained and eventually replaced. Then there's the cost of getting and keeping tenants. When a lease expires and you need to find a new tenant, You typically pay a leasing commission to the broker who brings them to you. That commission is often 3 to 6% of the total lease value. On a 5-year lease at $1 million a year, that's $150,000 to $300,000 out the door in commissions alone. And the new tenant almost always wants some form of tenant improvement, upgrades or modifications to the space to suit their operations. Those are typically either paid by the landlord or negotiated as an offset to rent. A large industrial building can develop a large dollar problem very quickly. A roof failure, a dock system overhaul, an electrical issue. Any one of these can turn a year that was supposed to produce $500,000 in cash flow into a year that costs you money. And the single greatest threat to warehouse profitability is not any of the above. It's an empty building. When a warehouse is vacant, everything changes. The rent disappears to zero. The property taxes don't. The insurance doesn't. The debt payment to the bank absolutely does not. Security costs remain. Basic maintenance remains. And you're now also spending money on marketing the space, paying for inspections from prospective tenants, and eventually paying leasing commissions and tenant improvement costs to bring someone new in. In a triple net lease, the tenant covers the operating costs during occupancy. The moment they leave, all of those costs revert to you, with zero income to offset them. This is what's called reverse operating leverage, and it's painful in a very specific way. The more efficient your building is when occupied, the more of the costs you've shifted to the tenant, the more dramatically the cost structure swings against you when they're gone. This creates an interesting tension in how you think about tenants. If you enjoy this kind of video, now's a good time to subscribe and hit the like button. It genuinely helps, and there's a lot more of this coming. Back to the tenant question. The natural instinct is to chase the highest rent you can get, but the economics don't always support that instinct. Consider two options. Tenant A offers to pay slightly below market rent, say $12 per square foot, but is willing to sign a 10-year lease. Tenant B offers $13 per square foot, but only wants a 3-year term. On the surface, tenant B pays more. But factor in what happens at the end of that 3-year lease. You're paying commissions again. You're potentially doing tenant improvements again. You have a gap period with no income while you find the next tenant. You're doing this process more than 3 times as often as you would with tenant A. The math over a 10-year period frequently favors the lower-paying tenant with the longer commitment. Not always, but frequently enough that smart operators think about lease term and tenant credit quality as seriously as they think about headline rent. This leads to another strategic question that every warehouse owner has to answer. Do you want one big tenant or several smaller ones? A single-tenant warehouse is operationally simple. One relationship, one set of negotiations, one rent check, often a longer lease with a creditworthy company. The problem is binary exposure. If that tenant leaves, whether their lease expires and they don't renew, or they go bankrupt, or they're acquired, and the new parent consolidates facilities elsewhere, your building goes from 100% occupied to 0% occupied overnight. Every single dollar of revenue vanishes simultaneously. A multi-tenant building distributes that risk. 4 tenants means that losing one costs you 25% of your income, not all of it. The remaining 3 continue covering a large portion of your fixed costs while you replace the one that left. The income is more durable, but multi-tenant buildings are operationally more demanding. Multiple leases expiring at different times. Multiple tenant improvement projects. Multiple sets of relationships to manage. Shared spaces that need to be maintained and allocated fairly. Common area maintenance charges that have to be reconciled and passed through correctly. Disputes between tenants, overloading dock access, parking, noise. It's a different kind of management workload, and for some owners, especially those who don't have dedicated property management infrastructure, it's genuinely difficult. Beyond rent, there are ways to generate income from a warehouse that most people don't immediately think about: exterior land. If your building sits on a parcel with excess acreage, that yard space can be leased separately for trailer staging, container storage, or equipment laydown. Industrial outdoor storage has become a remarkably in-demand asset class in its own right, because logistics operators need more staging space than modern warehouses typically provide. That excess yard generates meaningful income at high margins since there's almost no maintenance cost in a paved lot. Large flat industrial roofs are valuable to solar energy developers. The lease income, combined with potential utility savings, adds a passive income stream while someone else handles the installation and operation. A warehouse visible from a major highway can lease signage rights. Dedicated trailer parking stalls can be rented monthly to logistics companies. None of these replace the base rent, but together they meaningfully improve the total income picture, which, as we established, directly lifts the capitalized value of the asset. Now let's talk about how some investors deliberately buy underperforming warehouses and turn them into significantly more valuable ones. This strategy is called value add, and it creates value through capital improvement rather than simply waiting for the market to move. The typical target is an older industrial building, built in the 1980s or 90s, with low ceiling clearance, outdated loading infrastructure, and below-market rents. Modern logistics operations require ceiling heights of at least 32 to 36 feet. Older buildings often have 18 or 20. That difference alone eliminates them from consideration by e-commerce companies and any operator using automated racking systems. One technique that has emerged is a roof lift, physically raising the existing roof structure using hydraulic equipment. You're essentially jacking the top of a large concrete building upward. The cost runs between $10 and $40 per square foot depending on the scope, but the result is that you've doubled the usable vertical storage volume without acquiring additional land. Other improvements include upgrading the sprinkler system, cutting additional dock openings, upgrading electrical service, and paving the yard. The math on a well-executed value-add deal looks like this. In many U.S. markets right now, ground-up warehouse construction costs between $230 and $280 per square foot inclusive of land and development costs. A value-add buyer might acquire an older building for $160 per square foot and put another $40 into improvements, arriving at $200 per square foot all in, below replacement cost. With a modern asset that now commands significantly higher rents, the improvement increases NOI. Higher NOI, priced by a better cap rate, produces a compounded jump in property value. That's the lever. But to understand why this is so powerful and so dangerous, you have to understand debt. Almost nobody buys a warehouse with all cash. The standard approach is to finance 60 to 75% of the purchase price with a commercial mortgage. Debt is leverage. If you buy a $10 million building with $2.5 million in equity, borrow the remaining $7.5 million, and the building increases in value to $12 million, your equity hasn't grown by 20%, it's grown by 80%. The bank's piece stays fixed. Your piece compounds. That's the upside. The downside is that the debt has to be paid regardless of what the building is doing. If your tenant leaves and the building sits empty, the bank still wants its monthly payment. If interest rates rise when your loan comes up for renewal, which happened dramatically in the United States in 2022 and 2023, your debt service increases without any change in what the building earns. A property that produced solid cash flow at a 3% rate can produce negative cash flow at 7%, with the exact same tenants paying the exact same rent. Owners who financed industrial purchases in 2020 and 2021 at historically low rates, then faced refinancing 2 years later at rates more than double what they expected, lived this scenario. The building hadn't changed. The income hadn't changed. The math had. Beyond the monthly cash flow, warehouse ownership builds wealth through several additional mechanisms that don't show up on a monthly income statement. Every month your tenant's rent pays your mortgage. Part of that payment reduces the principal balance. The loan gets a little smaller. Your equity grows, not because the building is worth more, but because you owe less on it. Over a 10-year hold, a meaningful portion of the original debt is paid down by the income the building generates. That happens whether or not the property appreciates. There are also tax advantages. The IRS allows commercial real estate owners to depreciate a building's value over time as a non-cash expense, which can offset taxable income. Sophisticated owners use something called cost segregation, reclassifying specific components into faster depreciation schedules to front-load those benefits in the early years. It doesn't eliminate the tax, it defers it. But deferring taxes for a decade has real economic value. And over long periods in the right markets, industrial real estate has historically appreciated. Because land in good locations becomes scarce and replacement construction costs continue to rise. Now let's talk about what can make all of this go completely wrong. Economic recessions hit industrial real estate hard. When consumer spending drops, freight volumes drop. Companies need less warehouse space. Tenants who seemed solid go bankrupt or reduce their footprint. Vacancy rates spike. Rents fall. And you still have property taxes, insurance, debt service, and a building that needs maintenance. In 2008 and 2009, vacancy rates in major U.S. industrial markets jumped significantly, and owners who had bought with high leverage at peak valuations found themselves with negative cash flow, falling property values, and lenders who were not in a cooperative mood. Oversupply is a different but related risk. Warehouse construction in the United States surged dramatically in 2021 and 2022 as e-commerce demand appeared to be growing without limit. Then demand normalized, and millions of square feet of newly completed space came onto the market simultaneously. In markets where speculative construction was heaviest, parts of the Midwest and the Sun Belt, vacancy rates rose sharply and rents softened. Owners who bought at peak pricing found themselves in a market that had turned against them. Environmental contamination is a risk specific to industrial real estate and one that can be catastrophically expensive. Industrial buildings house manufacturing, chemical storage, fuel tanks, and other hazardous operations, and that history soaks into the ground. If you buy without thorough environmental diligence and later discover contamination, the remediation bill can be enormous, and under federal and state liability laws, the current owner is often on the hook regardless of who caused the problem. Functional obsolescence is slow-moving but real. A building adequate in 2005 may not meet the specifications modern tenants require today. Low ceilings, outdated electrical, inadequate parking gradually price older buildings out of the market for the best tenants, leaving owners competing purely on price. And transportation changes can alter location value in ways that are difficult to predict. A highway rerouting, a port shift, a major employer closing a facility nearby. So what does a warehouse actually need to earn to make all of this worthwhile? Let's build the full equation. You start with the gross potential rent, the total rent the building could collect if it were fully occupied at market rates. From that, you subtract your vacancy and credit loss allowance, a realistic estimate of the income you'll lose to empty space or tenants who don't pay. What remains is your effective gross income. Subtract the operating expenses, taxes, insurance, maintenance, management, repairs. What remains is your net operating income. Subtract the annual debt service, principal and interest payments to the bank. What remains is your cash flow before taxes, the depreciation benefits, and other tax considerations, and you arrive at your net cash flow after taxes. Then consider the equity you've built through loan paydown, the forced appreciation from any improvements you've made, the organic appreciation of the property over your holding period. Add it all together and you have your total return on investment. To give this real numbers, a warehouse acquired for $8 million with $2 million in equity might generate $400,000 per year in cash flow before taxes after a full renovation and stable tenancy. That's a 20% cash-on-cash return on the equity invested, which is excellent by any standard. But getting there requires the building to be well located, well improved, well leased, and well financed. 4 conditions that all have to be true simultaneously: a bad year, a 6-month vacancy between tenants, a roof replacement, an unexpected environmental issue, can take that same building from a 20% return to a negative return. The difference between the upside and the downside year in this business can be $300,000 or more. That gap is what you're being paid to manage. So who actually should own a warehouse? The ideal warehouse investor is someone with enough capital to survive the downside scenarios without being forced to sell. That means meaningful liquid reserves beyond the equity invested in the property. It means established relationships with commercial lenders who will work with you during difficult periods rather than immediately moving toward enforcement. It means the ability to carry the property through a multi-quarter vacancy without the debt service crushing you. It means local knowledge, genuine understanding of the submarket you're buying in, who the active tenants are, what they need, what's being built nearby, where rents are heading. A warehouse investor who doesn't know their submarket deeply is at a serious disadvantage to the operators who do, and those operators will consistently outcompete them for both acquisitions and tenants. It means either an ability to manage assets actively, to stay on top of lease negotiations, capital projects, tenant relationships, and market conditions, or the resources to hire people who can. The business is not passive. It rewards people who treat it as an active operating enterprise rather than a static investment. The best warehouse operators are constantly looking at their buildings. Which improvements would expand NOI? Which tenants are worth fighting to retain? And at what rent level? Which secondary income streams haven't been maximized? Where the next value-add opportunity is? Warehouse ownership is not a business for someone who wants to own a building and forget about it. The people who approach it that way tend to find out why eventually at a price that's difficult to recover from. But for someone who comes in with real capital, real market knowledge, a long-time horizon, and genuine operational capacity, an industrial building in the right location, leased to the right tenant at the right rent, financed correctly and managed actively, is one of the most durable wealth-building vehicles available in the private market. The building just sits there. The work is in everything around it. Before we wrap up, if you want to go deeper on how businesses like this actually work, the financial mechanics, the strategy, and the decision-making behind them, there's a detailed business guide linked in the description and pinned in the first comment. It's worth checking out. If this video gave you something useful, please like it, share it with someone who'd find it interesting, and subscribe if you haven't already. It means a lot, and there's a lot more coming. Thanks for watching.